If you have $20,000 saved in your checking account right now, congratulations. You are officially the person your bank branch manager complains about at dinner. I'm serious. To them, you are not a valued customer, you are a liability. You are a problem that needs to be solved. And if you don't understand why, you are leaving thousands of dollars on the table every single year, money that is rightfully yours. Most people think that hitting that $20,000 milestone is the finish line. It's not. It's the starting line for a completely different game. The game where you stop being the customer and start being the competitor. I remember walking into my local Chase branch 5 years ago with an $18,500 wire transfer I needed to send for a car. The teller looked at my balance, excused herself, and the personal banker came out. Suddenly, I wasn't just a guy in a hoodie. I was an opportunity. They tried to sell me everything: a relationship bundle, a premium credit card, a consultation with a wealth advisor. They didn't want to help me, they wanted to capture me. And in this video, you're going to learn exactly why that happens. We're going to break down the banking business model, expose the 3 specific reasons a $20,000 balance makes them sweat, and most importantly, I'm going to give you a step-by-step playbook on what to actually do with that money so you stop making them rich and start building your wealth. By the end of this video, you won't just have $20,000 in the bank, you'll have a system. You'll know exactly how to structure that money to maximize safety, liquidity, and growth, while completely flipping the script on the financial institutions you use. A quick word on why you should listen to me. I'm not just some guy with a spreadsheet. I spent the first part of my career working inside one of the largest banks in the world. I sat in the meetings where we strategized how to deepen relationships with customers, which is banker speak for extract maximum fees. I've seen the profit margins on deposits. I know what the algorithms flag. And I left because I realized the system is designed to keep you average. Now I manage a multi-8-figure portfolio, and I consult with families on how to build real, lasting wealth. I've made every mistake so you don't have to. Okay, let's get into the first reason banks are scared of you. It's brutally simple. You are not profitable enough. Think of a bank like a factory. Their raw material is money, your deposits. Their finished product is loans, mortgages, car loans, business loans. Their profit is the spread, or the difference between the near zero interest they pay you and the 6%, 7%, 8% they charge the borrower. Here's the problem. You, with your $20,000 sitting in a standard savings account earning 0.01% APY, which is a joke, by the way, you are providing them with very cheap raw material. That's good for them. But the cost to manage you as a customer is relatively high. You have a branch visit maybe once a quarter. You have a debit card that costs them interchange fees when you use it. You have customer service calls. All of this servicing cost eats into their profit they make from lending out your $20,000. A $20,000 deposit on its own just barely covers the cost of keeping you as a customer. You are a break-even proposition at best. But here's what they don't tell you. They're betting you won't stay at $20,000. They're hoping you'll dip into it. They're hoping you'll overdraft. That $35 overdraft fee is pure, high-octane profit. That one fee can generate more profit from your account than the entire $20,000 did for an entire year. They don't fear you when you have $20,000. They fear you when you have $20,000 and you never pay a single fee. Their entire business model relies on a percentage of customers messing up. If you are a perfect customer, you keep a high balance, you never overdraft, you pay a credit card in full, you're actually a thorn in their side. You're using their services without paying the stupidity tax they rely on. Reason number 2 is a little more psychological, but it's the real reason they want to move you out of that savings account. They fear your potential. You see, $20,000 is the gateway amount. It's the threshold where simple saving turns into actual investing. It's the amount where the returns from the stock market, from real estate crowdfunding, from treasury bills start to become significant enough that you actually feel them. The difference between keeping that money in their 0.01%
1% savings account and putting it into a high-yield savings account or a money market fund is the difference between earning $2 a year and $1,000 a year. They know this. They are terrified that once you realize you can get a 5% return with zero additional risk, you'll move that money out. And if you move it out of their bank, they lose the raw material. But worse, they lose the relationship. They know that the moment you open a brokerage account, you're likely to move more money over time. You are lost to them forever. They might never get the chance to sell you a high-fee mutual fund or a wealth management service when your balance hits $100,000. So what do? They try to trap you with convenience. They offer you a slightly better rate on a premium savings account, but it's still garbage compared to what's available outside. They offer you a financial checkup that's just a sales pitch in disguise. They're trying to build a moat around your money so you don't venture out into the wild west of the open market. But here's the controversial take. That $20,000 isn't even safe from them in a major crisis. We saw it during the Silicon Valley Bank collapse. Money over the FDIC limit can be at risk. But more importantly, your purchasing power is being silently stolen every single day by inflation. If your money isn't growing at least 2 to 3%, you are losing wealth. By keeping it in a traditional bank, you're paying a convenience tax that is quietly making you poorer. Before I reveal the single most important step you must take to protect yourself and start building real wealth, the step that turns you from a liability into an investor, we have to talk about the third reason, the one that nobody talks about, the one that makes you a target for the entire financial services industry. Because if you get this wrong, you don't just lose potential gains, you could actually end up back at zero. I'm talking about risk exposure. Okay, let's draw this out. You have $20,000. You think it's safe. It's in a federally insured bank. What could go wrong? The problem is you have mixed your money. You've put your emergency fund, the money you need for a car repair or a job loss, and your growth capital, the money you want to work for you, in the exact same bucket. This is a huge mistake. Scenario, you have a $3,000 medical bill. If that $20,000 is all in one checking account, you just swipe your debit card. Easy, right? Wrong. You just used your growth money to pay for an emergency. You just reset your wealth building clock. The bank loves this. They don't care why you're spending the money. They just want the transaction volume. But a sophisticated bank, they fear this because it shows a lack of financial structure. It shows that you are one small emergency away from losing your investing capital. Real wealth is built on separation. You need walls. You need buckets. You need to make your money hard to spend. And this is where the I tried experiment comes in. A few years ago, I had a client, let's call him Mark. He had $27,000 in his checking account. He felt rich, he felt secure, but he wasn't growing. We moved $15,000 of it into a completely different, less accessible bucket, a bucket earmarked for a down payment on a rental property. We left $10,000 in the bank as his true emergency fund. What happened? 6 months later, his car died. He was annoyed, but he wrote a check for $8,000 from his emergency bucket. It stung, but it didn't touch his investment bucket. A year later, he used that untouched $15,000 plus some savings to buy his first duplex. The bank would have kept him a customer. We turned him into a landlord. The bank fears that transformation. All right, so how do we fix this? How do you take that $20,000 and structure it so that banks fear you, inflation doesn't touch you, and you're on the path to real financial independence? You use the 3-bucket system. Bucket number 1, the safety net. For most people with $20,000, this is $10,000. This money needs to be boring. It needs to be liquid. It needs to be safe. Where does it go? Not your big bank. Open an online-only high-yield savings account. You should be getting 4 to 5% APY right now, guaranteed. This is your emergency fund. It earns you $400 to $500 a year just for existing. The big bank fears this because they can't offer it. Bucket number 2 is the wealth builder. This is $8,000. This money is for growth. This is for the long term. This goes into a low-cost brokerage account, Vanguard, Fidelity, Schwab, and you do something very simple. You buy a broad market index fund. Historically, the S&P 500 returns about 10% a year. This bucket is your engine. It will be volatile. It will go up and down, but over 10, 20, 30 years, this is the money that turns $8,000 into $80,000 or more. Bucket number 3 is the I Can Fund. This is the fun one. $2,000. This is your dry powder. This is for the opportunities the bank will never tell you about. See a course that could double your income? Buy it. Want to try a small real estate crowdfunding deal? Put $1,000 in. See a stock you believe in that's had a bad week? This is your play money. This bucket is for learning and for aggression. The bank fears this because this is the money that builds the skills and capital for you to eventually never need them ever again. Common mistake to avoid. Don't try to optimize too soon. Don't spend weeks trying to find the perfect 5.2% savings account. Don't stress over picking the exact right indexed fund. Just move the money. The act of structuring it is 90% of the battle. Paralysis by analysis is the bank's best friend. So let's recap what we covered today. First, we learned that banks see a $20,000 balance as unprofitable because the servicing costs eat up the revenue and they rely on you paying fees. Second, we uncovered the opportunity cost trap, how banks use convenience to stop you from earning real returns elsewhere. Third, we exposed the risk of mixing your emergency fund with your growth capital.
And finally, I gave you the 3-bucket system: safety net, wealth builder, and I Can Fund to structure your money like the wealthy do. Look, the financial system is not your enemy, but it is not your friend either. It is a tool, and like any tool, you need to know how to use it, or it will use you. By taking control of this $20,000, you are sending a message to the banks, to yourself, and to the universe that you are done being a passenger. You are taking the wheel. If this video helped you see your money in a new light, please hit that like button. It really helps the channel. And subscribe so you don't miss the next one. But now, I want to hear from you. Which of these 3 buckets do you struggle with the most? Is it keeping the safety net safe or taking the risk with the I Can Fund? Let me know in the comments below. I read them.